All right, welcome back everyone to today's explainer. We're going to do something really exciting today. We are demystifying exactly how to build a professional-grade trade setup completely from scratch. We aren't just staring at arbitrary lines on a chart here. We're actually going to synthesize high-level macro fundamentals with strict, unapologetic risk management math. If you've ever wondered how the pros connect global geopolitical events to exact, to-the-pip entry and exit levels on a currency pair, well, you are absolutely in the right place.
Okay, let's just jump right into our top-down analysis. First up, the fundamental macro backdrop. Then we'll look at the technical setup for the Australian dollar versus the New Zealand dollar. Third, we'll break down the specific trade idea itself. And finally, we'll wrap up with strategic risk management.
Let's hit that first point, the fundamental macro backdrop.
We're kicking things off with some recent intelligence from Westpac. They've been highlighting how the recent hostilities in the Middle East have, as you probably know, severely disrupted energy markets and spiked global oil prices. But listen, this isn't just a news headline. It's a massive inflation shock. Central banks literally cannot ignore this kind of supply-side disruption. Why? Because it directly hits household pump prices and quickly broadens into wider, sticky economic inflation.
And that brings us to a really crucial quote from the Reserve Bank of New Zealand's chief economist, Paul Conway. Notice the sudden shift in tone here. Literally just a week prior, the prevailing narrative was that lower oil prices would ease inflation. But Conway came out and warned that this new oil-driven inflation noise, combined with businesses just passing those higher costs right on to consumers, might actually force the RBNZ to tighten policy way further than the markets initially thought. They just cannot take well-anchored inflation expectations for granted right now.
So, what does this all mean? Well, it creates a very real fundamental narrowing policy gap between Australia and New Zealand. On one hand, you have the Reserve Bank of Australia taking a much slower, more measured approach after delivering 3 rate hikes. But contrast that with the RBNZ, where we are seeing a distinctly hawkish pivot. Overnight index swaps are now pricing in the official cash rate rising to around 3.0% by December. This policy divergence is fundamentally pressuring the AUD/NZD cross rate and heavily favoring the Kiwi.
All right, let's move into part 2. The technical setup for AUD/NZD.
Look at this specific number for a second, 1.1970. The folks over at Action Forex identify this as a highly critical neckline for a major double-top breakdown on the pair. That fundamental shift we literally just talked about, it is physically pushing the price down to test this exact floor. A decisive break right here completely opens the door for a much deeper drop.
And the surrounding technicals absolutely reinforce this bearish macro story. That 5-wave rally we saw previously is showing clear signs of exhaustion. Plus, we're seeing some really textbook bearish divergence emerging on the daily MACD. But perhaps most importantly, that 1.2000 resistance zone is acting like an absolute concrete ceiling right now. It is heavily capping any upward advances the Aussie tries to make against the Kiwi.
Let's move right along to Section 3, the trade idea explained.
So here are the exact parameters of the setup we're looking at. Now pay close attention here, because while the overall macro trend is clearly bearish, this specific idea evaluates a short-term counter-trend bounce right off a major floor. We're looking at a long entry for the Aussie at 1.1911, paired with an incredibly tight stop loss at 1.1890. Take profit targets are aiming right back up at that 1.2000 resistance ceiling and potentially stretching to 1.2050. We are essentially trying to catch a highly technical bounce off structural support before the bears fully take over the wheel.
But context is everything, right? According to the FX Torch desk view, keeping a very close eye on the 1.1900 support threshold is absolutely paramount. If the price breaks and sustains below 1.1900, our whole counter-trend bounce thesis is completely invalidated. It essentially confirms that the fundamental shift favoring New Zealand's terms of trade has taken total control, and the Kiwi is firmly gaining ground on the Aussie.
Let's jump into Section 4, Strategic Risk Management. Let's unpack why that 1.1890 stop loss makes perfect structural sense. By placing the stop exactly at 1.1890, we're safely buffering it just below that highly critical 1.1900 support zone. If 1.1890 is hit, well, the structural integrity of the trade is broken, our thesis was wrong, and we want to be out immediately. No emotions, no hoping, just pure structure.
The overarching point here is captured perfectly in this principle from the Como FX handbook. It explicitly reminds us that surviving drawdowns is your primary job. Risk management is not optional, folks. Every single indicator, entry, exit, or time frame you use is completely secondary to keeping your losses small enough that you actually get to come back and trade again tomorrow.
Okay, let's get into the math and directly apply the ComoFX position sizing formula to our specific setup. First, we define a fixed dollar risk. Let's say it's 1% of your account, or $100. Second, we measure our stop loss distance. Our entry was 119.11, and our stop is 118.90, which means we have a very tight 21 pip distance. Finally, you just plug that into the formula. Risk amount divided by the stop loss distance multiplied by the pip value. This is exactly how a professional dynamically adjusts their lot size to ensure they never exceed their fixed fractional risk, no matter how tight or wide the stop happens to be.
And speaking of fractional risk, comparing these two methods proves exactly why fixed fractional sizing is the absolute gold standard. Fixed fractional sizing automatically scales your dollar risk down as your account shrinks. Think of it like a parachute during a losing streak. It drastically slows your drawdowns. Fixed lot sizing, on the other hand, where you trade the exact same lot size regardless of your balance, is just mathematically inferior. Why? Because your risk percentage actually increases as you lose money, which rapidly accelerates your path to ruin.
As you go out and apply this, keep an eye out for these psychological pitfalls identified by ComoFX. The most dangerous one for sure is the temptation to size up simply because this AUD/NZD setup feels like a sure thing based on that hawkish RBNZ news. Let me tell you, the market does not care about your conviction. Also, make sure you aren't holding correlated trades that accidentally double your risk. Always leave a little buffer for price slippage around news events, and definitely triple-check your pip value, especially on non-USD crosspairs like the Aussie Kiwi.
To keep yourself disciplined with all of this, implement a 60-second pre-trade checklist. Literally, before your finger ever clicks buy or sell, run through this. Have you hit your daily loss cap? Have you calculated the exact fractional size? Is the stop-loss order actually placed in the system before you enter? If the answer is no to any of those questions, you do not execute, period. It's all about compounding that discipline.
To wrap up this explainer, I want to leave you with a final thought that really ties our entire top-down journey together. We know the math and we know the levels. But as you watch this currency pair this week, ask yourself, will the RBNZ's hawkish response to geopolitical oil spikes permanently break that technical 1.1900 floor, or will this prove to be just temporary inflation noise? The answer to that question is going to dictate the next major trend. Thanks so much for joining me on today's explainer. Remember to keep your risks small, and I'll catch you in the next one.